Hello, everyone. Thanks for attending this webinar on how to get ready for your next audit, specifically for museums and arts organizations. I'll go ahead and start by introducing myself. I'm Matt Gard. I lead the museums and arts niche within Armanino, work with about 25 different organizations in the museums and arts space, which is why I can speak to how an audit goes well, how an audit goes wrong, and what you can do to make the audit go more smoothly. Go ahead and turn it over to Dean and let him introduce himself.
Sure. Name's Dean Quiambo, Chief Relationship Builder here at Armanino. Basically help build partnerships between Armanino and organizations just like yourselves. Help you find out all the benefits of what it's like to be one of our partners.
And at the top of the pyramid, Katie Brown, Tax Director. I am the West Coast Practice Lead for our nonprofit tax group, and I support Matt and Dean on all of their audit clients as well. So we work together on a wide variety of organizations that are just like yours.
We know where our bread is buttered, Katie. That's why you're on the top.
Woohoo!
Yeah,
we know.
Well, definitely the focus is on the audit. Everyone knows that the audit then flows into the 990 prep and the tax return. And so there's issues that come up during the audit that impact that. And Katie will speak to how to make that, any of those issues, how to address those, as well as make the process from the audit through the filing of the 990 seamless.
And you know, we're much more picky for tax purposes. Our materiality is 49 cents and below, so we just dig into all the details. So we want to make sure you're covered during the audit process too.
Way to be a tax person, Katie. Way to show up. I like it.
Down to the penny.
All right.
All right, and to kick things off, we'll talk high level on a few things that you should be doing with your auditor. And then as we move through the presentation, we'll get into some of the nitty gritty details, certain accounts, financial statements, what those issues are, common entries, all that good stuff. But just high level things you should be doing with your auditor throughout the year. Number one, communicate often. As auditors or 990 preparers, we shouldn't just be hearing from you during that time. We want to have a year-round partnership where we're discussing with our clients what's going on at their organization throughout the year, not just at audit and 990 time. For a number of reasons, right? We want to understand what's going on so we can plan our work, but we also want no surprises, right? You don't want any surprises during the audit, during the 990 prep. If we're communicating with you throughout the year, understanding what new transactions are happening, what issues are occurring, we can help you through those real time and not have them become a surprise or an issue when we're doing our audit or tax work.
Yeah, exactly. And I think, Matt, what we see, if we don't have a client, if we have a client per se that does not communicate throughout the year, we normally find it in the other account. Right? Yeah. Is that fair? Yeah, these guys are both. Yeah. You should see the smiles on these guys' faces right now. Yeah, Katie, because what do you see? You see other liabilities, other assets.
Miscellaneous revenue. That's my most hated, because I need to know if it's unrelated, related, or excluded.
So. Right. And so you see that second line item right there that says be transparent. That's the opposite of that, because you just threw it into the abyss. All right. So let's talk about these issues all throughout the year. I have this transaction. We're here to help, right? We want to know about it, and we can actually get all the accounting done and get it right well ahead of reporting time.
Yeah, absolutely. I think one of the most common when we have a significant deficiency or material weakness type comment, it often relates to, you know, a transaction that came up during the year that wasn't discussed with us prior to that, and that, you know, may have gone unnoticed or recorded incorrectly. Whereas if we were consulted throughout the year, we would have addressed that, and it wouldn't have been an issue come audit time.
Awesome. And the last one, work through the PBC list with your auditors. I think the big thing here is that I know that everybody might feel like it's the contrary, but we don't want you to create specific reports just for the audit and just for the 990. We would like to leverage as much of the work that you already do throughout the year. And the only way that happens is if we talk about it, is if we say, hey, this is what we need and this is why. And you say, well, here's a report that I have. Does that meet your needs? Is that fair?
Yeah, no, that's a great point. We don't want you to have to recreate the wheel. We obviously have to get what we need to get for audit purposes, but if you're already preparing something that's similar, we're going to want to use what you already have, and we'll make it work for us. The other thing on this is just ask questions. If you don't completely understand something, talk through it with us as auditors. Don't just skip it, ignore it, think we won't notice that you don't provide something, because if it's on the list, it's something we're going to need. So make sure we get out in front of it and take the time to provide all these requests, several weeks before fieldwork. You don't want to be scrambling the Friday before we start the following Monday to try to upload all this stuff and find out that there's issues or you're not sure what's requested or required of you. Look at this several weeks ahead of time and take the time to provide everything. Make sure you understand the list, because that will lead to a smooth and successful audit.
Sweet.
The next are some just suggestions on how you can use us as auditors to help you. Like we talked about, we want to have a partnership. We're not just there to stamp the audit report, file the 990. We want to help you throughout the year. One of those things is internal controls and best practice recommendations. We work with arts and museum organizations of various sizes, from a couple $1 million budget to $50 to $100 million budget. So very different types of organizations, but we see best practices for small business offices as well as for large offices. And what we can do is help you. What are your peers doing? What are some of the best practices as far as internal controls that we can recommend to you? And we can also, validate if you already have a great control environment for a business office. That's something that we'll validate for when we, present to the audit committee or the board. Or where are there some areas where you could, fill in some gaps? If you do have a small office, how can you use, some other oversight from a board or finance committee to help with those areas? We talked about the second bullet point here a little bit. Complicated transactions. We wanted to talk about that in real time. Call us. We say that to all of our clients, right? We have a call us mentality. We want to hear from you throughout the year. We want to understand these transactions and make sure they're recorded properly. The last thing on here is just technology. We see a lot of different types of technologies amongst our different clients. If you have IT frustrations or you want to know what's kind of the best in class software for our type of organization, we can help with that. We can talk through it with you. I've just recently had an arts client that was doing so many manual processes, and we started just talking through, well, how could we automate some of those? What softwares that you may already have that you could automate some processes through that? This is ways your auditors can help. They should know different softwares, what's out there, and how to best utilize what you currently have to automate certain processes.
And we all know that the digital journey or transformation of organizations is happening all around us, really, right? We know that robotic process engineering and bots and data scientists are looking at ways to help all companies around us. And that includes nonprofits, right? And nonprofit is not excluded from that. We know, as Matt just talked about, how many manual workarounds are out there? Tons. And we have limited resources, right? We're burning out our people, right? How many people have multiple versions of the truth? How many have systems that are not integrated? These are all items that people are addressing head on when it comes to their digital journey, building their roadmap, and really trying to figure out, okay, here's all of the different systems we have. Is it possible to integrate? And if not, well, what can we do to maximize our use and really leverage these investments that we've already made as much as possible? As Matt said, we definitely can help there and give you insight into what other organizations are doing.
So now we're going to get into some of the, nitty gritty accounting. Obviously, that's for an audit. We're, opining on the financial statements, and some of the areas that make audits go wrong are some of those, nitty gritty accounting type items. So what we're trying to go through is we're going to go through the different items of your financial statements. Where do we see issues when we do these types of audits, and how can you avoid those going forward? We really want to try to give you the answers so that when we or your auditors come to do your audit, you've already taken care of all these kind of common issues or adjustments.
Yeah, I just want to highlight that, Matt. You just said it. We're going to give you the answers, right? We're going to tell you where we find all the adjustments, and hopefully you guys make this a checklist and say, well, hey, I might get a couple adjustments, but it won't be in one of these areas, because we're telling you right now where we're going. Here we go.
Absolutely. So to start, kind of where you always start on your balance sheet is cash, right? And generally,
cash is king.
Cash is always king. So The way we kind of laid this out is we talk about some of the common issues with each of these accounts, and then we'll give some best practice tips on what you should do ahead of time, to make your audit successful. So with cash, completeness from an audit standpoint, completeness is kind of always the area we look at, right? Do we know, are all the accounts that the organization have, are they recorded? So we always need to have a complete list of accounts before we send any confirmations. We really need to know any account that the organization has, right? And making sure that we can confirm it, get bank statements, etc.
Yeah, I mean, it's easy to audit cash when you know all the accounts. The biggest thing is, oh yeah, and we have that one account with this group that does fundraising for us off to the side, and it's not on our balance sheet. Well, that's what we're talking about, right?
Yeah, absolutely. So that's best practice tip here is make sure you maintain a listing of all accounts, bank name, type of accounts, account number. To Dean's point, just because it's another, kind of auxiliary organization, they do the fundraising or whatever, it's still part of the organization.
Exists for your benefit.
Exactly. That should be part of your books. And so it's important to keep that and track that and, make sure your auditors are aware of those amounts. Last thing on here is just kind of common account audit adjustment is if there's any cash that's held in investments that should be reclassed to cash, right? If it's really cash, looking at what's in your investment account, what amounts of cash should be reclassed to the cash account on the financial statements. And speaking of investments, that's our next section we'll be looking at. This is for a lot of museums and arts organizations, particularly some of the larger and well-established ones. This might be one of the most critical accounts on your audit. Big dollars, those that have big endowments have big amounts invested, right? So there's a number of issues here that we look at. Some of the most common ones relate to planned giving agreements, right? Again, Dean mentioned it's easy to audit something if we know it exists. A lot of times we don't know these exist, right? Planned giving agreement, right?
Oh, you mean this?
Yeah. When we start asking some of the questions, some of the buzzwords, like, oh yeah, I have a drawer of all of, these
Are you
things.
talking about this?
An attorney, notified us of this, but we didn't know what to do with it, so it's in our drawer.
It's in the other drawer, not even on the books.
Well, and a lot of those, if they are actual split interest trusts and things like that, have to be reported on your 990 as related organizations if you have more than a 50% remainderment interest. So we need to know about those from the tax side too. And sometimes we're finding out by reading the audit footnotes. And so we're hoping.
Knowledge bomb. Thank you, Katie.
So it's just really important to, and there's, from a GAAP accounting standpoint, there's requirements for when those types of agreements get recorded on your books versus when they don't, and maybe are just disclosed or maybe not even disclosed. But what's important is anytime something new comes in that's a trust, you're named in a will, bequest that's of significance, you should just be running that language by your auditor, making sure both on the same page for how to handle this, right? Because if it is an irrevocable gift that needs to be recorded, the calculation and accounting behind it can be pretty complicated. So it's very important to get that done and addressed well in advance of audit time to make sure that's handled properly. We talked about reclassifying of cash. I'll move on to the next one. This is one I'm seeing a lot in the arts and museums and all nonprofits actually space is non-public investments, right? So if a donor contributes stock in a non-public company to your organization, how do you value that, right? It's non-public. You now own the shares to it. You might not be able to sell it for some time. How do we value that, right? So anytime those types of things come up, again, you need to talk with your auditors about it because you'll have to come up with some sort of value, right?
Yep.
That those amounts have value, and going forward, you may increase in value, they may decrease in value if the company is not doing well. But it's important to start talking about those and trying to determine how do we come up with a valuation for this.
And I think there it's really going to be open communication and working together, right? No one person is going to be able to assign that value, but we definitely want to work together as much as possible. And we did live through this, right? One of our clients was in the Wall Street Journal for a $15,000 seed investment that turned into $40 million. And that was with the IPO of Snapchat. one of our favorite apps. But that is happening more and more and more. And so I think the big thing there is to, make sure you have the policies around it. And again, talk to, different methods that we can all use to get valuation.
I was going to bring up policies as well. That's one of those things that makes a lot of sense for organizations to look at if you're going to be receiving stock that's hard to value, something that is privately held. Your Form 990 does ask you whether you have a gift acceptance policy that requires review of any kind of non-standard donations like that. And you just want to make sure that you're not ended up saddled with some strange asset that you have a hard time getting rid of. You don't want to be stuck with some weird thing that you can't, we've seen that too, where there's been a strange partnership interest, totally illiquid, they're stuck with it forever. So you just want to make sure you're reviewing those kinds of things too.
Yeah, absolutely. As these are becoming more common, and I'm definitely seeing them much more, making sure you have a set policy in place for how you want to handle these is very important. Similar type item is, real estate. That happens all the time. Donors contribute real estate to the organization. Again, how do you value that? Has there been an appraisal? Stuff that when that comes up, you want to understand what the valuation looks like and start talking with your auditors about that. Katie, do you want to talk about partnership investments and K1s?
Yes.
Oh yeah, your favorite.
My very favorite. So if you have any partnership investments that are not in a blocker corporation, if you're receiving any Schedule K1s, we need to see those from the tax side. A lot of times they're passing through different types of foreign filing requirements. Sometimes it's state unrelated business income tax. Sometimes it's federal unrelated business income tax. So please gather those and send them over either with your audit request or your tax request. We'll take them anywhere we can get them.
Great. And then just to finish off on investments, some other best practice tips. Any auditor is going to be asking to see a roll forward of their investment activity. That's going to flow into your cash flow. It's going to tie to your certain, trial balance accounts. I'll be surprised how many organizations I go to that aren't keeping track of this regularly, whether it's monthly or quarterly, showing a roll forward of your investment activity. Definitely something you're going to want to prepare ahead of time. And again, to, I guess, Dean's point earlier on, this is probably a schedule you already have. It'll likely, if this is something you're tracking, be able to be used as part of the audit. You don't have to use a certain template that your auditor might require. We want you to leverage this existing reports that you're already using. The last couple of things on here is, as you know, for financial statement purposes, there's leveling of investments, level 1, 2, and 3. Are you tracking those? Have any of your investments, if you're in alternative types of investments, have they changed levels? Do you know why? These are different things that you're going to want to talk with your auditors about to make sure they're properly disclosed in your financial statements. The next section, the accounts receivable. In general, this is not as a significant area for arts and museums organizations. You may have some receivables from customers for memberships or events or whatever it might be. It's typically smaller amounts, but just some things to look at. Collectability is what your auditors are going to be looking for here. How long have these receivables been on the books? Are they able to be collected? Something you should be considering, if they have been on the books for quite a while, does a write-off or allowance need to happen? And lastly, as a best practice tip, just make sure you have a detail that agrees to the GL, right? A detail of all these accounts receivable that shows the aging as well, so we understand how long these have been on the books and what kind of allowance might be required. Contributions receivable, this can be definitely a significant area for arts and museums organizations, right? Outstanding pledges. A couple of the issues come up here, again, similar to the accounts receivable side, is collectability, right? If you have pledges that the donor is not making their planned pledge payments, right? Is there an issue? Should an allowance be recorded? Should write-off potentially have? Something to look at, right? And I guess it's not here as a best practice tip, but it's probably one of my #1 best practices in this area is making sure the business office and development are meeting.
And your CEO, executive director. That's the triumphant, right? Because a lot of times we know that the major gifts are being done by the CEO of the organization and the director of development, and then the CFO finds out later. You guys need to be a team and be talking about change in payment terms or anything of that nature, right? And if you guys have it, that okay, if they've gone out and they've changed payment terms with that donor, Matt, then that they've given you as the CFO or finance manager the support that you'll need for the audit in case it changes some of the calculations or supports lack of allowance or things of that nature.
Right, absolutely. That's probably the number one area we find adjustments in this area is there was a change and the CEO knew about it or the head of advancement knew about it, but wasn't communicated to the CFO or the business office. And when we ask about it, we get that explanation afterwards. Couple other issues, making sure all unconditional pledges are recorded, right? That's GAAP. If there's an unconditional promise to give, that should be recorded. Conditional pledges, if there is a condition attached to it, may not be required to be recorded. It may be required to be disclosed. So it's just really understanding the language in any of these pledge agreements and understanding, is there a condition that needs to be met before we can record it? Matching gift is often a common conditional pledge, and really understanding what's the difference and when do these types of items get recorded. The last one I just mentioned on here that we see a lot, probably see it definitely several times a year, is when relates to restrictions on contributions receivable. There can be purpose restriction, right? I give you this gift for a building or whatever it might be.
That's the easy one.
That's the easy one, right? It's right there. But there's also an implied time restriction, right? If the money is not going to come in for several years, that's not unrestricted dollars. You can't use those now. You don't have the cash in hand. So that implied time restriction still needs to be recorded as a temporarily restricted net asset, or as a asset without donor restrictions, as the new language would require. But it's just something to understand that you should always have, if you have a pledge, you really have a restriction still because there is an implied time restriction. The last two best practice here is just making sure you have a roll forward of your pledges, right? You have a beginning balance, you have your new pledges, any pay downs. And again, that aging, right? To understand when were these pledges supposed to be paid? If they are not meeting the required pledge schedule, should we consider some type of allowance or write-off here? As well as the aging will be used to calculate present value discount, right? You need to record your pledges at present value. So if those dollars aren't going to be received until over the next 10 years, you will have to record some kind of discount to present value those amounts. So it's important to understand when these dollars are expected to come in and have that aging so that your auditors can review it and then look at that present value calculation. Fixed assets, generally one of the larger dollar amounts, I think, for many museums and arts organizations.
And seems like it's happening right now all over the place. Everybody is raising money and building something.
Yeah, absolutely. So really what we're going to focus on here is the second bullet point on here is construction, right? That's when there's typically audit issues in construction because they're large dollars. And two, there's a few accounting issues that come along with those that we'll talk about here to make sure we understand. So first, a common error that I see is that kind of last progress payment on your construction for if you're a June 30th year end for that month of June, sometimes does not get recorded. By the time you get that bill after all the subcontractors and everyone else have billed the GC. By the time you get that bill, it might be several months later, right? You may have closed out your books already. In August, September, you finally get that June billing that could be a substantial amount, goes unrecorded oftentimes because, like I said, it may take several months before you get that billing, but those costs were incurred prior to year end and should be recorded. The other thing related to that gets missed a lot is retention on that, right? And retention is generally that kind of 10% holdback that gets held back to make sure that the contractor meets all the final checklist, punch list items, project is actually completed. So that 10% of every month's billing that doesn't have to get paid at that point, those costs have been incurred and should be accrued as retention payable. So something to always look at is One, what's our last billing for the month of June before we close out the books? And what's the retention of that amount, because that should be accrued for as of that date. Last item on construction that's a common adjustment as well is, when do you, so you're doing this capital campaign for this project, when do you release from restriction those construction dollars that are restricted?
I know logically you feel like, hey, I had a bill, I paid it, I had to use some dollars to meet that construction obligation. I feel like I should be able to release that dollar, right?
Right. I mean, that would make sense.
Logically.
But really, you're not allowed to release any of those restrictions until the project is placed into service. The donor is giving you money to build this building, and until that building's built, it's not released from restriction until that point. So something to look at, that even though you're spending dollars, the release from restriction does not occur until that asset is placed into service. Last few things on here, just repairs and maintenance, making sure that if everything's being expensed, making sure you're looking at your capitalization policy and capitalizing those assets that exceed those thresholds. Leases, right? We have the criteria for what's a capital lease versus operating lease right now. In a couple years, and they're talking about deferring this a little bit further out. All leases will be on the balance sheet, but at this point in time, really analyzing, should it be a capital lease, should it be an operating lease, and making sure it's recorded properly. Best practice tips is having that fixed asset roll forward, right? That's the number one thing your auditors, your 990 preparers are going to ask for is, what's that beginning balance? What makes up the activity during the year to get to your ending balance? And you're going to need detail of what those additions, disposals, any construction costs, what those all look like. So very important to track those and have that roll forward prepared as part of this process. And then lastly, a depreciation schedule to show when the asset was placed into service, and then the calculation of depreciation going forward. Moving on to, now that we're through the assets, to the liability section. Generally, AP and accrued expenses, usually don't see too many issues on these areas for your organizations. Again, is the AP account complete? Were all the cutoffs always going to be the big issue? If there's invoices that come in after your balance sheet date that relate to the period under audit, making sure those are all accrued. We talked about the construction one that's often missed, but any other types of items, making sure that any that have a service period within the fiscal year are properly accrued. On the salary and benefit side, making sure the payroll is properly accrued for the period that has occurred. So if the payroll is not paid on the last day of the month, if it's paid after that, making sure those amounts are accrued for the payroll that was earned during that period.
Yeah, I got a question for you guys. And I mean, it's coming up here with contracts and loans with executives, but I'm thinking about, potential severance packages or retirement packages or anything like that. Anything come to mind there that you guys might have some thoughts or insight to share?
Yeah, I think, those are definitely things that can trigger liabilities, right? And those are items that do get missed. So usually as part of the audit, we will ask for those contracts with executives. If there's, when we look at legal type costs, if there is a severance, we'll ask to look at those agreements to make sure those liabilities are properly recorded. Again, we'll typically ask for those, but if you as a client are aware of these types of items, again, bring those up to your auditors to make sure that you're comfortable that a liability should or shouldn't be recorded and that it doesn't become an audit issue later on.
And a lot of those things are disclosure items on the 990 as well. So if you've got a 457F plan for executives where they're accruing retirement compensation that is not recognized currently, we have to report all of that on the 990. Also, any sort of benefits that are not included in their taxable income, whether that's car reimbursements, reimbursements for other dues for clubs or things like that. All of that for your executives is going to be disclosable on the 990. So especially for new employment contracts, if there are variable payments or bonus payments that they're eligible for, that's something that we look at pretty closely because it is a large disclosure item and people are really sensitive about that. when you've got your personal W-2 information and all your benefits out there, sometimes the total number ends up being more than the person kind of was expecting. And when you're looking at these big numbers on the return, it's easy to say, oh, is that really accurate? So just be prepared for that, and then be aware that we're going to be asking you for that information.
Great. And then just best practice tips on that is making sure you have detailed schedules that support those liabilities, right? So you have an AP detail that agrees to your general ledger balance. You have your PTO accrual calculation that supports your entry there. Again, you may have detail behind any of the other types of liabilities that we've talked about.
Oh, one other thing I almost forgot to mention.
I love it. Give it to us. Give it to us. Come on.
So Section 4960 is a new law that came in with the Tax Cuts and Jobs Act, where if you have total compensation of over $1 million, there's an excise tax on the organization. So if you have usually we don't see this on an annual basis because most nonprofit executives are not making over $1 million. But in the case where you have a large vesting event, for example, from a 457F plan, you could easily have a year where for one or two executives, you're over $1 million. The total amount that's over $1 million is going to be taxed at 21% to you as the employer, not to the employee. So that's something to be aware of. And if you think you might have something like that happen in the near future, you can look at changing the vesting schedule perhaps, or spreading it out over 2 years instead of just one, to help avoid that tax. And usually the executives don't want to have the organization incur a tax for that amount either. So it's something you can kind of work together with them on.
Great, thanks, Katie. Next item, debt. We talked about, Dean said everyone's building right now. So most of the organizations are, having to take out some debt to finance those buildings. Biggest issue for debt that, I see as an auditor is relates to debt covenants, right? So typically these debt agreements are going to have certain covenants that must be met. You as a client, are you evaluating compliance well ahead of the time, right? Because if we come out to do the audit and you haven't really looked at it, and all of a sudden you're in default of your debt agreement because you haven't been properly tracked in your compliance, right? That's a surprise that you don't want, that your board committees don't want. So it's very important that you're monitoring this throughout the year and pro forma or looking at how we expect to finish off the year and if we're going to be in compliance, because this is something as an auditor, one of our biggest areas that we're going to look at, right? Oftentimes the audit might be for the debt holders, and we want to have to make sure that the organization is in compliance with any of the covenants related to them.
And of course, I'm always worried about tax exempt debt. They don't usually call it a bond anymore. It seems like normally these are coming through a bank, but if they're guaranteed through any kind of government agency, CETA or CFA or anything like that, if they're tax exempt, there are very specific requirements for arbitrage evaluation every 5 years. And also, if you have any activities that are taking place in your tax exempt financed facilities that are not directly related to your exempt purpose, so if you've got rentals and things like that, if you're having weddings in your museum, those are things that you need to look at because they can give rise to unrelated business income tax, and they can also put you out of compliance with your debt covenants for the tax exempt bond. You're only allowed to use it for 5% over the life of the loan for non-exempt purposes. So if you have heavy use in the beginning years, you really need to evaluate and make sure that you're not out of compliance at the end of the loan. The consequence for failing any of these requirements around a tax exempt loan is that it's no longer tax exempt all the way back to the beginning. So that means that you're going to have a lot of investors who all of a sudden have taxable interest that they thought was non-taxable for the past who knows how many years. So it's pretty catastrophic. We want to avoid that at all costs.
Yeah, absolutely. The next one is just, again, giving us an idea of, is there any new debt? Was your previous debt refinanced, debt extinguished? Talking through when any of those types of transactions happen, start talking through that with the auditor. Some of that can have some accounting impact that we should be discussing. If you do have a line of credit, making sure your auditors are aware of that. I know I've had a few situations where, the organization may not have borrowed on it, right? So again, we see there's zero balance on the GL, but really you have an open line of credit that one needs to be disclosed, and two, gives the organization some availability. And when we talk about the new liquidity disclosure that was effective this year, that will be disclosed as part of that footnote. So making sure that just because you don't have an outstanding balance, if you do have that line, we need to know about it. We need to disclose that in your financials and include it as part of your liquidity disclosure.
Yeah, very strategic there, I think.
Yep. Best practice, typically pretty basic, but just again, debt roll forward, showing what's the ins and outs in your debt amount. And then again, compliance with your debt covenants, providing us that calculation early on and making sure you're in compliance throughout the year, and having that ready for us when we start the audit. Net assets is one of the more critical accounts we're looking at, right? The organization have fiduciary responsibility for those, restricted assets to meet requirements of the donors. So it's something we look at a lot to make sure that restrictions are properly recorded, they're released when they should be released. You'd be surprised how many times that I come into an organization that, is not regularly preparing a net asset roll forward, showing how restrictions roll forward. Oftentimes for arts and museum organizations, it can be one of the more time-consuming parts of preparing for an audit, right? A lot of times they'll have lots of endowment accounts, have lots of restricted assets, and schedules need to be prepared to show that activity. So a lot of times this will be a big undertaking to prepare the schedules for this part of the audit. Couple, items to consider. One, does your GLO balance agree to the ending prior year audited financial statement balance, right? So does your net assets roll? Do you have the listing of donor restricted assets? Do you have listing of those releases? I guess this is a good time to talk about as well as the new financial reporting standard that's definitely, if you're at 12/31, you may have already gone through this. If you're June 30th, you're going through it now, but just some of the verbiage related to net assets is changing, right? We're also comfortable with unrestricted, temporarily, and permanently restricted. Some of that verbiage goes away, that it's now either without donor restrictions, right? You're unrestricted, or with donor restrictions that, was previously bifurcated between temp and perm. You'll be using that new verbiage going forward. And just kind of as a best practice tip here is that you shouldn't change how you're tracking this. If you already have your net asset schedules for your temporarily and permanently restricted net assets that you've been doing for years, keep those schedules, right? The underlying accounting behind this doesn't change. You still need to know what has a temporary restriction versus a permanently restriction. Those two items will just roll forward together on the financial statements under your with donor restrictions. But you'll still need to know what they are, because in your footnotes, you'll have to show what's endowment, what's restricted in perpetuity versus what can be used for when time and purpose restrictions are met. I guess the last thing I'll mention on here, that just kind of a trend I'm seeing in the niche with museums and arts organizations, is a lot of organizations are using technology to handle some of these processes, right? To track their net assets, because in the past you may have Excel schedule with so many different tabs and items going from one to another. Well now there's software that can track all your endowment accounts, what the ins and outs are. So something that I've seen from a few organizations that are clients of mine have implemented, and it's really streamlined this process for processes that would take hours each week or month to do, can now be done once it's set up with the click of a button to provide these schedules that show this. So something to consider that I know a lot of organizations are looking at.
Yeah, I mean, how many times do we talk to someone and it's the time of the year to do the audit, and you talk about schedules just for the audit, and we have some organizations that leverage technology and some organizations that are trying to do the roll forward, and it takes a long time. I mean, that's one of the biggest roll forwards that for some organizations with significant endowments and significant restrictions, that roll forward is a lot of work. To the extent that you could leverage technology and be reviewing it instead of preparing it, could be beneficial.
Absolutely. Okay, so we're through the balance sheet. Moving on to the income statement. One, we'll start with program revenue, right? So this is your admissions, your memberships, your ticket sales, all that good stuff. Just a couple items here. Do you have detail that reconciles to your GL? Should be from your software that tracks all this, but it should be able to tie back into your general ledger. Couple things, just revenue recognition versus deferred revenue, right? Making sure you have your revenue recognition policy and that it's recorded properly. What is recognized now versus what's deferred, right? Where you haven't, met the recognition criteria yet. And the last thing on here is something you'll want to consider and talk with your auditors on is how does the new Rev Rec standard impact how you record revenue? Everyone's heard about this. There's countless webinars and different things related to the standard, but with some of the changes, as many museums and arts organizations may have memberships that have different performance obligations within those memberships, how does this change in how performance obligations are defined, does that change how you recognize revenue? Do you have to bifurcate these out and recognize revenue at different times? For some organizations, it may not be material, but for some it will be. So this is very important to start looking at it, talking with your auditors, and making sure you have a memo or policy in place to how you're going to account for the new revenue recognition standards and how it impacts your organization going forward. Contribution revenue. So we talked a little about this when we talked about the pledges. So I don't think we need to hit on all of this all the information on here. But
I think the main point, Matt, is just the fact that, for most of the organizations out there, we're going to be hitting investments hard. We're going to be hitting contributions receivable hard. And the other side of that is going to be the contribution revenue, right? We're going to look at net assets, right? Those are going to be areas that we have lots of journal entries, right? If journal entries are going to happen, those are the areas where it's going to happen, especially because right now we're seeing a lot of capital campaigns out there, and organizations don't go through capital campaigns every single year. So it's transactions that you might see once every 5 years or something like that.
Yeah, you nailed it. Those are the areas, users of the financial statements, that's what they're going to be looking at. That's what they're concerned with, right? So those are the areas we're going to be hitting hard. And like Dean said, those are the areas that often have adjustments because they're not as recurring as your general operation type items. Restricted contributions, just remembering the difference between what the restrictions are, making sure those are tracked correctly and with the donor's intent. If there are restrictions met in the same year as it's given or pledged, you can have an accounting policy that allows you to release those in the same year, but you have to do it consistently and keep that going forward. Talked about conditional gifts. Again, anytime there's a condition attached to it, you should be looking at that, talking with your auditor to make sure you're comfortable. Is this really a condition that causes us not to be able to record this, or is it so minor that we can still record that? Verbal contributions. A lot of times I'll go into organizations that just have a policy. Yeah, we don't record verbal contributions. Accountants like to be conservative. If it's verbal, they may feel like that might not come in, so let's not.
Unless you have a documented history of coming through over and over and over again.
So GAAP allows you to record those verbal contributions. Like Dean said, if you have that history that every year the same donor gives us the same amount every year, they verbally tell us about it, then yeah, that's something to be recorded. So organizations shouldn't just have a policy that we don't record verbal, but it should be one where you consider it on each unique situation. The last thing on here, and I think I'll turn it over to Katie to talk about fundraising event revenue and allocation between contribution and non-contribution portion and the issues that come along with that.
Yeah, this is a tricky area, and it's hard. I think people have a hard time with it because when you're looking at a fundraising event, you know what your expenses are going to be, but sometimes a lot of that is donated. And so if you're disclosing to donors what's the deductible portion of their contribution to this event, so say you've got a $200 event, it's going to have dinner and entertainment. We need to look at what's the fair market value that the donor is receiving, not what is the cost. So maybe you get everything donated and you're saying, okay, so your entire contribution is deductible. Nope, we have to look at what are they receiving in exchange, and we have to look at it from a fair market value perspective, not cost. So this should be disclosed to them when they are purchasing their tickets. So it's something that you have to determine in advance as well. And then it does need to be disclosed in order for their any portion of it to be deductible, you have to give them a written acknowledgement if it's over $250, but I think most organizations are giving them regardless of amount. But you do want to make sure that you're disclosing that to them as they purchase the tickets, to make sure that you don't have any confusion about what is actually deductible versus non-deductible.
Yeah, I know this one comes up all the time.
All the time.
I know I've probably sent Katie a number of different emails like, I don't know what to do here, Katie, but what do they need to do? So yeah, very important.
And if you have questions on it and, you want us to look at, basically we're suggesting that you look at what the cost would be for a person to attend a similar event if it were not a fundraising event. So there can be a bit of a disconnect between the amount that is seen as revenue from the event, non-contribution revenue, versus contribution revenue, because maybe it doesn't make sense when you're thinking it through. But because it is based on fair market value, it can be a little confusing, and we're always happy to help review your analysis of that situation.
Great. Okay, moving on to expenses, and kind of the key area we look at here and that we may find issues with, and because it's an estimate, it's that functional expense allocation, right? How are you allocating those indirect expenses, your key employees' time, what's being allocated between program and supporting services, your facility costs, how are those allocations being done? Are there any changes to that methodology? Do you have support for, how you've determined that those are appropriate allocations? And are they in line with industry standards? So these are all things we look at as part of when we audit your functional expense allocation. The other key thing here is, and I guess it's a good time to mention now, is with the new nonprofit reporting changes a little bit what needs to be disclosed related to expenses in the financial statements. Previous requirement was you just had to present your expenses on a functional basis, what's program versus supporting services. The new standard requires that expenses in the financial statements be reported by both functional class as well as natural class. So natural class being your salaries and benefits, your facility costs, your depreciation, all that kind of stuff needs to be presented together and in the same spot. So that's a new change for this year that will be in all, nonprofit financial statements. Good news is most of, I think probably all of you that are listening to this already prepared a 990 that requires this already.
Mm-hmm.
So you already have a starting point, right? And then determining how much of that information do you want to put in the audited financial statements. You don't have to show the same requirement that the 990 requires. You can simplify it quite a bit, but you use the 990 reporting as a starting point, and then can determine how much of that, what are the significant categories that you actually want to put in your financial statements.
Seems a lot easier to start from the required categories on the 990, which we can't change, and then you can combine them down into more general categories for the audit if you'd like, because
it definitely feels like less is more.
Yeah.
Right. Let's start with what's required, and then let's, be strategic about what we're gonna share out there. It seems like and then also let's, in the same vein, let's also think about what's the industry standard. What are other arts and museum organizations doing? And let's think about it from that standpoint. Let's be consistent.
Yeah, it is tricky because your 990 is public, so anybody can look it up, and I think most organizations share their financials if asked as well. So it's just something you kind of want to be sensitive to. Sometimes you'll hear things from the rating agencies saying that you have to have a specific percentage of, in program versus management versus fundraising. I think the consensus in the nonprofit community is that we're trying to get away from these kind of forced percentages that aren't very accurate and perhaps not as useful to readers. And it doesn't mean that you're a bad organization if you have different allocation percentages. But something that people do talk about and to be aware of, but I would encourage you to ignore the hype of the ratings agencies and do what actually makes sense for your organization and is the most accurate representation of what you're doing. Easier said than done.
No,
right?
That's a good point. but it still comes up at every single meeting we have.
It does.
But
what's GuideStar going to think?
Exactly.
Yeah.
Exactly.
And that's where just having a pulse on the niche and what your peers are doing is really going to be your leg up.
And we can encourage each other to get away from
these
kind of forced false percentages.
Okay, the next one we're looking at here is leases. And really, with the lease standard coming up in a few years here, and all leases are going to be, essentially capitalizing on the balance sheet. This really, the biggest impact here is for those organizations that may lease their facility, right? Because if you're leasing a facility, bigger dollar amounts, you may be leasing it for 20, 30, 40 years for a very long time. Coming up with the present value of that is a little bit more of a complicated calculation, and it's something that's going to be in effect here in a couple of years. So you want to start looking at that as, if we are leasing our facility, what's that calculation going to look like? Because it could be a very large amount that's going to be ending up on your balance sheet as a right to use asset and liability. Katie, I'll let you shine.
Here we go.
So in looking at tax reporting, there's just a couple of things that I wanted to bring up to everybody. One, again, is that special fundraising event income and expense. We really want to encourage you to look at that during the course of your audit prep and planning, because we have to go into a lot of detail on the 990, and that sometimes happens a couple of months after you've already completed your audit. And then when we start digging around in the details, it was perhaps immaterial for the audit. And then when we're looking at it for tax, we've had plenty of situations where people said, oh no, we misclassified something in the audit and now it's not going to match the tax return and the audit's wrong. So I want to encourage you not to feel like the audit is wrong. It is immaterial for audit purposes, then you're good to go. But if you want to avoid that uncomfortable moment, I would strongly encourage you to have a look at that during the course of the audit, and to reach out to us if you want to just make sure that it makes sense for tax also. It's much easier to just have it flow the same on the tax return as the audit. You have less to explain to your board, et cetera. So I really encourage people to look at their fundraising event expenses that are going to be reported on Schedule G in advance while you're working on the audit. The other major thing is reviewing for unrelated business income streams. As I'm sure you know, the unrelated business income tax rate for corporations is now 21%. That means if you have unrelated business income of $90,000 or less, you're actually paying more than in the past. So we want to make sure that you are very confident on your positions in terms of what we're paying tax on and what we are treating as excluded. So things that are hot button, common, unrelated business income streams. The first one is the new one, employee fringe benefits for transportation and parking, and then employee parking on site at work under section 512A7. There is some rumbling in
Yeah,
the
I was
House
gonna
Ways and
say,
Means.
come on, Katie, help us out here. I've been reading things online. Come on.
I have not seen anything make it to the floor. I have
But they're
not
talking
seen,
about
they're
it, right?
talking.
Okay.
There was
Giving us a
scheduled
sense of
hearing.
hope.
Right. There was a scheduled hearing last month that they ended up canceling at the last minute because of a scheduling conflict, but it was not rescheduled, and we've heard other commentators out there saying they think that is a good sign, meaning that there wasn't any discussion between the Republicans and the Democrats. Everybody kind of agrees. So some people are feeling really confident that it's going to be repealed. We don't know yet. And at this point, I can't advise you to ignore it. So have a look at that. We're happy to talk through your position on it as well. The second one listed there is debt financed rental income. So if you have acquisition indebtedness on a building and you rent any portion of it out, to the extent that it is debt financed, that is taxable income. Rental of items other than space, which is technically personal property, or space rental that includes significant services is another issue. So if you're looking at things like wedding rentals, events, parties, and you're providing significant services, catering, cleanup, setup, all that kind of stuff, we need to look at it because it can potentially taint the entire revenue stream.
Okay. And then also just kind of related to that, we do have a lot of organizations with debt financed property, and they do rent it out and make some, hey, additional streams of revenue is good. What about the property tax aspect of that?
The assessors are insane investigators. I don't know how they find this stuff out so early, but I've had lots of clients tell me that as soon as they started a rental activity in a debt financed facility, the county assessor comes around and says, oh, good, well, let's have a look and see what percentage of this is taxable to you now. So if you've got a property tax exemption, that's something you want to think about pretty carefully, because their wizardry is amazing. Like, I don't know how they find this stuff out. Thank goodness they don't work for the IRS. Let's just put it that way. One other item is, advertising income and other exploited exempt activities. So typically, if you're publishing a magazine or a newsletter and you sell advertising in it, that's going to be considered unrelated business income. Similarly, if you have other exempt activities that are going on and you think, hey, you know, while I'm doing this, I could make a little money if I did this extra activity, that's what's referred to as an exploited exempt activity, and advertising is the most common example. But, you know, if you have a website and you're, you know, using your mailing list for other things, that's also an exploited exempt activity. So those kinds of things, if you've got questions, just let us know. And then again, the partnership pass-through UBTI, more and more the partnerships are disclosing unrelated business income at a state specific level. And we have many clients that are required to file in anywhere from 8 to 37 states because they have unrelated business income that is specifically generated in those states. So if you've got K1s, please send them over to us so we can help you in advance know what your filing requirements might be from that. So best practice tips are going to be review your investments for UBTI exposure, and then maintain records of fair market value received by attendees at special events. That's one of the real tricky areas that is really important. Deductibility of membership dues. This is a really tricky area. For those of you that have membership programs where people are paying an annual fee and they receive access to your facility, and then at varying levels, they might have other benefits that they receive. The deductibility of the membership dues has to be very carefully analyzed. There are some very complex guidelines that come down to, you know, is the fair market value received by the attendee for this specific event less than $9.70? So it's very, very specific. We're generating a worksheet that will help guide our organizations in figuring out how to do this. But the guidelines are very specific, and there are different rules for organizations if you have no membership levels above $150 versus those that do. And the deductibility on that is kind of crazy. So we're happy to help you review your membership levels and look at what the benefits are. You know, things that they consider not fair market value received, or things that are of such a small value or that you could use repeatedly. So like access to the museum, that's always going to be considered a de minimis benefit, because you technically could go 365 times a year, and the individual value of each of those visits when divided by $300 or something is not relevant. Other things like discounts to camps and summer programs, discounts at stores, and things like that, we really need to look at. So definitely ask your tax team to review if you're not sure that the deductibility of your membership dues makes sense. You're not sure whether it meets the guidelines, you're not sure if it's reasonable, you want to know what other organizations are doing, talk to us about that. We're happy to help. And we really recommend that you keep records documenting what your determination of the deductible amount is for each level, because that's something that the IRS, you know, there is some potential for them to gather revenue from auditing this area, not from you, but from your donors. You know, if they're challenging somebody's 1040 and their charitable contributions, and they say, well, I gave $5,000 to my museum, they go back and look at that and say, oh, well, look at all these benefits. Actually, you received $2,000 of value, so your contribution is only $3,000. That's an adjustment that can happen on audit to your donors. So we want to make sure we're giving them accurate information so that they don't have any trouble with their donation to the organization later. There's nothing that I think discourages a donor more than getting reamed on something from an organization that they wanted to support. So we want to make sure that this is as correct and accurate as possible. The other item I wanted to bring up to you today is other taxes that your organization can be subject to. One of these is sales tax. So if you're selling any items, including in a fundraising auction, let's say you have a silent auction at your event, your donors who are purchasing those items are required to pay sales tax. You're required to withhold and pay over sales tax on those sales. So if you are having those types of events, you need to register with the CDTFA, that's the new California Department of Taxation and something administration.
Did you say
Taxation and
new?
fee
So this is a new
administration.
thing?
Yes, it broke off from the Board of Equalization.
Okay.
So they broke apart the Board of Equalization and created CDTFA, and then Board of Equalization is handling other items at this point, other excise taxes. So that's something that I think a lot of organizations are not aware of and are not necessarily doing. If you have a gift shop, you probably are, but you need to look at your fundraising events also. And I know it's kind of annoying to have to charge sales tax on an auction item that was donated to you, but the burden is on the purchaser. And so when you are facilitating that sale, you're required to withhold and pay it over on their behalf. Again, property tax on your property where UBTI activities are taking place, they're very aggressive. Watch out for that. Another area is registration and filing in other states. If you have charitable solicitation in other states, the state attorneys generally have jurisdiction and will require you to register and to report to them. In a lot of states, you can use the URS, the Universal Registration, and they will accept that. And there are also lots of organizations or lots of other service providers that can do all 50 state registration for you. But also, if you have charitable activities or small fundraising meetings, or if you're doing presentations in another state, that can be enough to generate nexus as well and require you to register with that state's Secretary of State to conduct business. And you'll want to make sure to let them know that you're an exempt organization. But just so that you know, if you've got offices, remote employees, anything like that in another state, we need to review and make sure whether you have a filing requirement there. Some states are really aggressive and others are very laissez-faire. So let us know and we can help you figure out where you might need to file. So be sure to look at, especially when you are hiring remote employees. Some states are very aggressive on saying that creates nexus and they want, payroll taxes. Sometimes actually the payroll tax collecting agency will refer your organization to the Secretary of State and say, oh, we're receiving payroll taxes from this entity. Are they registered to do business here? Because they are. California is one of the
That's just too logical.
that does that. I know
That
they
kind of
share
makes
info.
sense, right?
Yeah, they share info. So we got to watch that. And then I think that was it on this one.
Great.
Yep.
So I guess just to summarize, following these best practice recommendations, make your auditors happy, make the tax prep piece of it go smoothly.
We just want it to be easy for you.
Absolutely. We'll just show this here just to what's next. We talked about a lot of, these upcoming accounting standards and when they're effective. There's lots of information about all these different items that you can reach out to us about. Otherwise, I think thanks for listening. Hopefully these tips will be helpful to make a smooth process. And, happy auditing season coming up here real soon.
Spoken like a true auditor right there. Unreal. Anyhow, thank you so much for tuning in. And definitely, if you have questions, and I think that's the biggest thing, the biggest takeaway is be talking often, addressing those questions. Don't leave anything in the other buckets, and work with your partners. They're there to support you. All right. Thank you, everyone.
Thank you.
Thanks.